6 assets that are better than cash. Many people have always believed that cash is better than anything. Well, that's simply not true. Money is better, and it doesn't have to be in cash form. If you have excess cash in your pocket, you can either multiply it or buy a better asset than cash. In this video, we'll share some assets that are better than cash. Having cash in your savings account is not always beneficial. You can use this cash, invest it, or buy something that can increase your financial stability. Let's look at these assets one by one. Number 1. Stocks and shares. One of the most popular alternatives to cash is investing in equities, that is, stocks and shares. The benefit is that, in comparison to cash savings, you may experience longer-term and frequently shorter-term growth. Equities can be very appealing, especially when cash interest rates are low as they are right now. The drawback is that, since stocks can lose value as well, you might lose money, sometimes even all of it. Anyone who purchased soon before the COVID-19 disaster will have lost a sizable portion of their investment, which may take years to recover to its previous level. The COVID-19 catastrophe took a third off the prices of worldwide stock markets. You should always be aware of the risk. Over longer periods, 5 or more years, however, stock markets consistently exceed the majority of cash savings. By purchasing a variety of securities or using a fund, you can also spread your risk. Although the risk of loss is not eliminated, it can be greatly diminished. You can keep the risk at levels you find acceptable if you properly prepare your strategy and seek help. Here are some other ways to invest in stocks besides just purchasing shares. Stocks and Shares ISA. A tax-efficient savings account, an ISA, does not charge taxes on growth or interest. An ISA for stocks and shares holds non-cash assets like stocks, but can include things like bonds and investment trusts as well. It makes sense to utilize a Stocks and Shares ISA for any investments you purchase if you're going to be investing less than £20,000 annually. Although adding a cash ISA to your savings may lower your £20,000 yearly limit, cash ISAs now offer very few benefits due to the historically low return rates. Your investment can increase inside the ISA more quickly than it could outside of it by reinvesting the growth plus the tax savings. Index funds and ETFs. Index funds and exchange-traded funds, or ETFs, are a very simple way to begin stock market trading. In comparison to open market speculation, they can be a safer vehicle because they eliminate the burden of selecting individual equities. Both kinds of mutual funds invest in a variety of securities with your money. Securities include equities but also bonds. These broad market funds are seen as lower risk since their diversity might shield you from sector-specific crashes. There are several options available, and while some are significantly riskier than others, you can choose one that matches your degree of risk tolerance by seeking impartial guidance. Unit trusts and investment trusts. A trust deed establishes unit trusts, which are a type of group investment. A fund manager will make investments on your behalf in a portfolio of assets using pooled funds. The trust seeks to invest in high-yielding assets, typically stocks, bonds, and real estate funds, and typically distributes any profits either as income or growth on a quarterly or biannual basis. As always, returns are not insured, and you could experience a financial loss. Unit trusts and investment trusts are similar, yet there are some significant differences. One is that, unlike unit trusts, investment trusts can borrow money to purchase additional shares. This increases their potential for growth while also putting the investor at more risk. An investment trust's net asset value is determined not only by the value of the assets it owns, but also by the market price of its shares. If the net asset value surpasses the share price of the investment trust, you have the opportunity to increase your profits. Value investing. Value investing is a strategy for more seasoned investors and is a major factor in Warren Buffett's success. The idea behind value investing is straightforward. Purchase discounted stocks in promising firms and sell them when the company has lived up to its potential. So much for the theory. The challenging part is locating these businesses and forecasting their future success. You'll probably need a few years of investment experience to be successful in your firm before you can accomplish this as well. It requires perseverance and a sizable initial investment, making it only suitable for wealthy investors. 2. Bonds. You might prefer investing in corporate or government bonds if you think that the ride on the stock market will be too choppy for you. A bond is essentially a loan to the nation or business that issues it. For a few years, you lend them your money, and they repay you with interest. As a result, bonds are frequently employed to produce a predictable return over a specific period. Although bonds are sometimes characterized as having lower risk than equities, the truth is a little more complex. The most secure bonds are often those issued by stable governments. But developing markets or new company bonds will be much riskier and should have better yields. It's about weighing the risks and potential rewards, as it always is. 3. Peer-to-peer lending. Peer-to-peer, or P2P lending, is a variation on the bond theme that has gained popularity recently. This likewise involves making loans and having them returned with interest, but this time the loans are made to individuals as well as businesses through an online central lending platform. Due to the potential for substantially higher interest rates than a cash savings account, P2P platforms are advertised to consumers in a manner that superficially resembles savings accounts, but it's vital to keep in mind that they are not the same thing. You risk losing your money because while governed by the FCA, they are not covered by the Financial Services Compensation Scheme, or FSCS, if the provider goes out of business. Return estimates are likewise not warranted. However, there's a chance to generate consistent returns from the large platforms, some of which have been operational since 2005. 4. Crowdfunding. Crowdfunding is a distant relative of peer-to-peer financing and involves making a direct financial investment in a startup business or initiative. Equity or investment-based crowdfunding gives you a stake in the company and eventually a cut of the profits. One of the quickest ways to increase your wealth is to be fortunate or astute enough to predict the next great thing, as did the crowdfunders of the online bank Monzo. It is much more likely that the corporation will only give you a thank you and possibly some complimentary items. Crowdfunding is more commonly associated with speculation than with investing, yet it certainly works for certain people. 5. Oil, gold, and precious metals. Investments that have their own glamour include oil and gold. Despite their reputation, they usually don't lead to wealth quickly. Oil and gold are effectively poles apart as investments, since gold is renowned for being stable during times of crisis, whereas oil is fundamentally erratic. Supply and demand, as well as international policies, are the key drivers of oil prices. Therefore, oil stocks, futures, or options can be a good investment for the small portion of your portfolio that is considered to be high risk. Any profits made here can be skimmed off and invested in safer investments, while any losses are contained to the modest sum you invested. On the other hand, the performance of gold often reflects that of the whole economy. In other words, gold tends to depreciate or stagnate during periods of strong economic growth. However, because gold is the last resort asset, its value tends to increase when stock markets drop and uncertainty looms. Because of this, gold is the perfect counterweight to volatile commodities like oil. Keep this in mind when balancing your portfolio. 6. Pension. Pension funds, while not an asset class as such, can serve as both a short-term and long-term investment for those nearing retirement. If you're in your late 40s or older and considering investing for the next 5 to 10 years, your pension shouldn't be ruled out as a possibility because it can be accessed at any age starting at 55. Tax reduction will effectively increase everything you pay by 25%, and all growth is tax-free as well. Take guidance before making this decision because there are drawbacks to receiving your pension early. Choose the right investment strategy. If you have extra money in savings or income, whatever you decide to do with it, make sure you have a plan. Don't just choose the path that appears to offer the biggest profits because the risks involved might not be appropriate for your objectives. This ends the video for today. Hope it'll help you grow your money. Like, share, and subscribe to the channel to learn more.